There is one main factor that is going to determine whether or not you achieve financial independence within your lifetime. But the craziest part about it is that most investors either ignore or don't pay enough attention to this single detail that can make such a big difference. So in this video, I'm going to show you all there is to know about this incredibly important factor. And then I'm going to show you how focusing on it can massively increase your lifetime investing returns to make you reach financial independence as soon as possible. But to truly understand this concept, we first have to go back to the very principles of investing. When we invest in a stock or index fund, we are investing in the public businesses and corporations that are listed on the stock market. So by definition, the returns that the market produce must equal the gross returns earned by all investors in that market. That's just a fancy way of saying that if a market earned £1 million of returns in a year and 100 investors invested in that market, then the gross returns of all of those investors would have to equal £1 million. Now, that seems like a fairly obvious thing to say, but bear with me. The key thing to note here is that we are talking about an investor's gross returns, but to figure out an investor's net returns, as in what they actually end up with, you have to take into account costs. But the thing is with costs is that they are not all equal. Some investors pay more than others for a whole range of different reasons. And to go back to our example with our 100 investors, they will have all earned the same gross returns, but the investors who minimize their costs will have earned the highest net returns. And if we assume that the average investor cost is 2%, then the net return of all those investors has reduced to £980,000. The other £20,000 has gone missing, or into the pockets of investing brokers or financial advisors. And you simply cannot escape this fact. Investors who carry the least costs will, on average, end up with higher net returns than other investors in that market. But the thing that most people don't know is exactly where their costs are coming from. And because of that, they have no control over it. I can guarantee you that there are some costs that exist that you weren't even aware of, that are eating into your returns silently. And you need to know where to look for them. So before showing you the shocking data about how much costs affect your returns, let's first identify where exactly these costs come from. I've managed to break these costs down into 5 different categories, with an added one that deserves a mention. Some of these are more obvious than others, but there will be some in this list that you won't have even considered, and that's what makes them so dangerous. The first cost that you often have to pay before you even start to invest is a platform fee, and it's basically the cost that you have to pay just to use that investing platform. And because of that, they affect all investments that you're going to make on the platform, making it a sort of universal cost. Most platforms typically charge a percentage ongoing fee, say 1% of your total portfolio value, but there are other platforms that charge a flat fee that's not going to change depending on how much you invest. The percentage fees often work out cheaper for smaller portfolios, but as your portfolio starts to grow in value, then the flat fee options start to become more appealing. A few examples of platform fees include InvestEngine at 0%, Vanguard at 0.15%, AJ Bell at 0.25%, the HL ISA at 0.45%, Forrester's Friendly at 2%, and Interactive Investor at £120 per year. So based on this, we have a cost range of 0 to 2% so far. But there's more to come. The next fee is one that most people are aware of, and it is the expense ratio of the funds that you invest in. It's worth noting that these don't affect individual stocks, but all ETFs and index funds come with a cost, which is associated with the managing and advertising of the fund. There's not really too much to talk about here, other than that you can expect to see significantly higher costs for more niche funds and certainly for actively managed funds. The average costs range from as low as 0.05% in the UK, with an average cost looking something like 0.2 to 0.3%, but with some funds having a fee as high as 2% per year. So the cost range that we have has now increased from 0.05% up to 4% per year. And we've barely got started. The next cost is one that is associated with the buying and selling of stocks and funds, otherwise known as a one-off cost. These really only sting you twice, either when you buy or when you sell, so it's not considered to be an ongoing cost, but that doesn't mean that it's not going to impact you. They tend to vary massively depending on the platform that you use, either being a flat fee or a percentage cost based on the market spread. InvestEngine are an example of a platform that offer no dealing fees. Vanguard, however, have a range of ongoing costs for their ETFs, but it's typically lower than 0.1%. Unless you choose to invest in an ETF instantaneously, then you're going to be paying £7.50. HL have a range of costs, from being free to $5.95 or even $11.95 in some cases. I'm not going to add these to our cost tally because it's a one-off cost, but make sure that you still consider them when investing. The next cost is probably the sneakiest on this list, mainly because most investors don't even know that they exist because investing platforms try to hide them. It is known as the fund transaction cost, and it is a cost that is associated with managers of the funds buying and selling the stocks that make up the funds that you invest in. So the more that the fund buys and sells stocks, otherwise known as the turnover, the higher this transaction cost is going to be. Jack Bogle himself estimates that these costs average as high as 1% per year per turnover rate of the fund. So if a fund has a turnover rate of 50%, that's going to be a 0.5% fee. iShares in the UK are quite upfront about this cost and tend to include it in their total expense ratio, which is nice. But for most companies, with Vanguard being a good example, you have to dig through their website to find their full costs and charges sheet, and then try and find the transaction cost for the funds that you invest in, which can turn out to be much higher than you'd expect. The FTSE Global All Cap Index Fund, for example, has a transaction cost of 0.09%, adding 39% on top of the already existing 0.23% fund ongoing cost. Portfolio turnover for UK funds can vary a lot, with some being as low as 1%, with the average value around 50%, but with some funds having a turnover of above 300%. That would make a transaction cost range of 0.01% to 3% per year, making them potentially the most dangerous costs that we've seen so far, especially when you consider that they are the most invisible one. We'll add this to our tally, making our range equal 0.06 to 7%. The final legitimate cost that you will experience as an investor is taxes. Now, this is a very difficult one to define, as it's going to vary massively from person to person, depending on your portfolio value, what you invest in, and what tax wrappers you choose to use. The main taxes that we face as UK investors include capital gains tax at 10 or 20%, depending on your income, and dividend tax, which can range from 8.75% to 39.35%. It's worth noting that you do have a tax-free allowance for both of those, and you're not going to be paying taxes if you invest inside a stocks and shares ISA or in a pension. But whilst I'm not going to focus on them too much today, taxes can turn out to be the most expensive cost that you face over your investing lifetime, especially if you don't manage them properly, so make sure that you think about them. I'm not going to add them to the tally that we have so far, just because of their complexity, and I'll make sure to do the same with this next bonus cost, which is inflation. Whilst we don't technically pay any fees for inflation, it is a silent killer that is always eating into your returns. The annual inflationary amount should always be subtracted from your investing returns to receive your real returns, especially when inflation is as high as it is now. With the current inflation rate sitting at 10%, we are paying a constant 10% annual cost just for owning the Great British Pound. Gotta love it. But if we focus on the total annual costs that are associated with investing, we have a range of 0.06 up to 7%. Now, of course, these focus on the extreme opposite ends of the spectrum, but it just shows how making a few simple decisions can massively impact the yearly cost that you pay. And before we show just how devastating even the smallest of costs can be, in the examples above, you will have noticed that InvestEngine was often the cheapest option. They charge no platform fees for DIY portfolios, no dealing fees, and you can invest inside a stocks and shares ISA for free, which ticks off 3 of the boxes that we've listed above, making them the ultimate low-cost option. You can sign up to their platform using the link at the top of my description, and you earn £25 when you invest your first £100. Terms and conditions are in the description below. But the truth is that the costs that we've talked about don't really count for anything until we run some real numbers on how they will affect an investing portfolio, and I guarantee you that you will be surprised by the results. So when we're calculating total investing returns and how much costs are going to impact them, we of course need to have a good idea of how much we can expect to receive. And these annual returns are often quoted as 7 or 8%. Or sometimes even higher. But in reality, that could be quite an overestimation. The latest forecasts often quote future stock returns to average around 6% per year for global stocks. So we'll roll with that for now. I'm going to run through a couple of different examples to show you how different scenarios are impacted by a range of costs. This first chart shows the growth of £20,000 over 50 years, earning 6% annualized returns with no deposits. The portfolio value is shown on the left. As is typical with investing, the growth starts off fairly steady, but increases exponentially as time goes on. I've now added a couple of different lines which represent a range of costs, with green being 0.1% and yellow being 0.5%. The 0.1% fee of course tracks the no fee line pretty tightly, without a major change in the time taken to reach each portfolio value. But even as we move down to just 0.5% fees, the difference starts to become quite significant, taking an extra 4 years to reach a £200,000 portfolio value. I've now added 2 more costs, with the orange showing 1% fees and red showing 2%. The impact is simply devastating, with the lines shallowing out massively. The 1% fee takes an extra 8 years to reach £200,000, and the red line doesn't even get close after 50 years. It's crazy to think that just a few extra percentage points can take so much away. But trust me, This next graph is going to blow your mind. This chart shows the returns that you keep when investing at a range of costs over a 50-year period. The blue line at the top is always at 100% because you are paying no fees, so you always keep all of your returns. The rest of the colours represent the same fees as before. The green and yellow lines perform fairly well, showing that even after 50 years, you end up keeping the majority of your investing returns. But for the 1% fee, that amount falls to 60% after 50 years. And for the 2% fee, you lose 50% of your returns after just 35 years of investing. In fact, after the entire 50-year period with 2% fees, you only end up keeping 37% of your investments, with the rest going to your investment provider. In other words, the no-fee investment ends up with around 380k, but the 2% fee ends up with only 147k. Now this just seems literally unbelievable. How can a 2% fee end up costing you over 63% of your returns over an investing lifetime? Well, the most dangerous thing about costs is that they compound too, just like your investing returns. So that 2% fee doesn't start off taking huge amounts away, but as time rolls on and your portfolio value grows larger, you end up giving away an eye-watering amount. This next graph shows the growth of the portfolio starting at £0, but with monthly deposits of £300 per month, which better represents a typical investor. The story is still pretty much the same, with the lower fees doing a good job of keeping up with the investment without fees, but the higher fees trailing massively. The amount you keep is almost identical too, although the effect is less pronounced. This is just because you are constantly adding new money to the portfolio, and the 2% fee isn't affecting that new money for the entire 50-year period. But either way, with 2% fees, you still lose almost 50% of your returns after 50 years of investing. This just shows that you can never underestimate the devastating effects that costs can have on your portfolio. We should be doing our absolute best to remove every unnecessary cost possible, whether it is platform fees, fund transaction costs, ongoing costs, one-off costs, or taxes. Because if we settle for unnecessarily high fees, we could massively increase the time that it's going to take to reach our financial goals. If you needed 500k to become financially independent, this example shows how the difference between 0.1% fees and 2% fees changes the time taken from 38 to 47 years. By reducing your investing costs, you could potentially reduce the time taken to reach financial independence by almost a decade. It's that simple. But just knowing that costs are important is not going to be enough on its own to help you reach financial independence. There is one more concept that you absolutely need to understand, and without it, the information in this video may as well be worthless. And that's why you need to watch this video here, because I show you the massive mistake that investors are making that stops their portfolios from growing to their full potential.